Welcome to the closing beat, everybody. Happy Thursday to you. Having a good day? All is good out there? Good. We are financial advisors here at Jazz Wealth. Welcome to our show. While other advisors are playing checkers, we are playing chess here, and we're really focused on tonight's Wine and Wealth class, which is sort of a double give you today here. Wine and Wealth tonight for our clients. We do it every Thursday night for clients. The goal is I can't reach out to you guys every week, every one of you. It would just be silly to do that. But every week I want to bring you some lessons, some education. And this week we're going to do, in just a couple hours, basics and advanced tax strategies that you could do before the year end. It's real simple to look up the basic stuff that you can do. We'll cover that, but then we're going to go into some advanced stuff that you probably haven't thought of either. So if you are a client, you want to join us, come on and hang out there. Otherwise, I will get right into it today. Hope you're doing well. Doc, Eloy, 6676 Gunman. That's also, that's a nice name. The markets. Has it shocked anybody? All right. If you've been watching the past couple days and really the past couple weeks, the performance day to day probably hasn't shocked you. Right? There's not much that the market is doing that's out of the norm. Little jitters here and there, but otherwise we're basically just moving along as we should there. We had initial and continuing jobless claims come out. They're actually moving a little bit higher there, a little bit higher than expected actually, which was a bit of a downer to start the day. Walmart reporting earnings, we'll talk about that. Also a bit of a downer there. The jobless claims are a little tough to look at. I'm going to show you just for fun. I don't know if you guys care about this stuff, but here's the initial jobless claims. You see in the background, this is this one here. See how it's hard to look at? That's COVID. Remember when we all went and applied for unemployment because companies just shut down? We're like, well, all right, let's do that. So that spike kind of skews the chart. I zoomed in a little bit, top left-hand corner for you so you could see. The concern is that just like anything else, right? When something bad starts going up and becomes more prevalent, we think, oh my God, was that the bottom? And now we're going to just start ticking higher and this is getting worse. This happens every time. What I think is interesting to note, whether you're looking at the long-term average or the sort of midterm average here, we're still below average, right? So it's still a historically low number there. And unfortunately, it's just hard to give you a good view of it because COVID kind of screws up the charts there. So it is what it is, but I thought that'd be fun to share with you guys there. As far as the stock market goes, we know that after having such a severe run up there, that the next week, the next month tends to be a little choppy. It doesn't mean we can't go higher. It just means we won't go higher as fast as we've come off these lows. So understandable today's performance, the back and forth and all of that, understandable yesterday. We actually looked at the data if you want to go back and see how we came to that decision. It's not magic 8-ball type stuff. It's just, hey, this is the mood, right? They say that the stock market doesn't repeat itself, but it rhymes. And that's all we're looking at. We're just, what's the rhyme here? We got that same personality kind of going in the stock market. Now, my argument, which is more of an opinion, is that the stock market has overpriced the Fed cuts or the impact of those Fed cuts. So we're obviously a magnificent rally off of lows, pushing 10% off the lows there. And it's like, yeah, okay, what's going on? What's the belief that the Fed is going to cut rates sooner and faster than we previously believed? It's not actually true, though, right? And the Fed tells us that themselves. There's no gray area here because the Fed actually says, hey, we're not going to use 1 or 2 months of data or 1 or 2 data points to suggest that mission accomplished. I think the Fed president, the lady that's retiring, Loretta Meister, I believe she even said the same thing today. Hey, we're going to need more information. It's looking good, but we're going to need a little bit more information there. So that's kind of understandable. 7% gains in 10 days we know is well above what the market normally does. And if we look at bonds, we can actually see, well, oh, that's why people are doing it. Right? Oh, you think the Fed's going to start cutting rates, therefore you should buy bonds and rates will start going down. No, it's not going to be an immediate just turn of the corner like that and the Fed's going to start cutting. Also, you should get your mind wrapped around the fact that when they do cut, we're talking a quarter point. There is no way, barring a severe collapse of some part of our financial system, there's just no way that the Fed says, okay, rates are here and you know what? Inflation's where we want it. Let's just cut a whole point. No, that is not going to happen. It'll be a test cut. And then things are going well and inflation's not rising and everybody's kind of doing, borrowing a little bit more. Okay, a test cut. That's how things are going to go there. So be very careful when you start wrapping your mind around Well, when rates go down, the housing prices are going to go up. That's not a one-day event. That will be over the course of many months, because they're going to be lowering little by little by little. Again, unless, like, you know, credit cards or something just blow up and we all stop paying them, and there's this huge, like, financial catastrophe like we've seen in the past, but not predicted, or at least assumed to be headed that way right now. Okay, so that's my belief there on the Fed. That's kind of an opinion there. We're up 17% year to date. What's interesting is about a quarter of those gains year to date, not the bounce, but a quarter of those gains have happened in the last 30 days. That's not normal either, right? So we're moving at a pace where I don't want the mindset. I don't want you thinking like this is just what the market does. Right? We have those little moments where that happens. Don't get that mindset there and you'll keep yourself out of trouble. All right, if we look over to, I'd like to point out the Russell, actually, something I've been watching a lot closer. It's one of my favorite indices to look at. I love the small cap stocks. It just, to me, is fascinating there. It was the weakest by far overall and today. Now, if you look at today, it was across the board. Small cap growth stocks, small cap value stocks, the whole index, right? All very, very weak, at least across the board here today. Volatility in the Russell 2000. So I'm big on volatility because if I can invest in something, like I used the example with a client earlier, if you bought a house in Miami and you bought a house in Wichita, Kansas, nothing wrong with either one of those places. Where do you think you're going to see more price volatility and long-term appreciation? Which location? It's probably Miami. Use New York and Wichita, Kansas, or New York and Sioux City, Iowa, right? Chances are you're not going to see a lot of growth in that house, but you're going to see a much more condensed price action. It's not going to wiggle around tens of thousands of dollars based on what Saudi Arabian prince bought some plot of land. It's not likely anyways. Well, when you look at the Russell 2000, we now have volatility that has doubled itself, right? In just like the last 60 days. Hey, take a look. So here's the Russell 2000 as used or proxied by the IWM. I just use that because it's the most popular one there, right? So if we just plot volatility on the chart, we could see, yep, it's doubled, right? But is that a big deal? Is this the normal volatility or is this the normal? Are we way above what we normally do or not? That's all we want to know. And if you look further into it, well, you can see here, this is a long-term average for the life of the IWM here. We're just slightly above average. In other words, if you choose to participate in small caps in your 401k at work or a small cap fund here at Jazz, the volatility, the day-to-day back and forth is pretty much what it normally does. We had a moment where it was less. Let's go back over. We had a moment where it was less volatile. We've had many moments where it's been less volatile, but this moment in time right now is about what it is. Right? And so those kind of things are good to know because how many times have you bought stock A and stock B, or you bought an index, the Dow and the Russell, and you look at them and you're like, Jesus, this thing over here's going crazy. This thing not so crazy. Both of them are returning roughly the same amount, at least at this point, but this one over here is doing this while this one's really quiet, right? What does that do? It causes you to make bad decisions. I'll just give you the answer, right? Whenever you have a stock that is wild, you gotta know if it's just normally wild. Cisco, look what happened to Cisco today. Is that normal? No, nope, that's not normal, right? You want to know those things. So then you can say, what happened in Cisco today was not normal. Do I need to make an adjustment? Should I consider a different investment? Should I add to this investment, right? So I love pointing out those kind of things there. Okay, ramble. Let's go on here. The Dow working its way back up there, actually getting stronger by the day. That's starting to win me back over there. The NASDAQ, of course, we know is very, 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 very close to highs. Tried to get above there yesterday, couldn't do it. Not the day for it. It has done a lot of work to get itself up there, and that's understandable. The price of gold bouncing off the 200-day moving average, just been pointing that out each day. It seems to be the next level of support there. Bonds ticking a little bit lower there, but all of a sudden, what's happening? We're getting back into that range where we're chopping around. Indecision, guesstimates on the future, no solid data, just day-to-day trading. That's what you see going on there. The price of oil, I'll point out a couple things here. I don't know if I'll hit the mark with what you're interested in, but we're down over 20% off of highs there. Right? It's a tough one to go counter trend, but it is impressive that it's down 20% off of highs. If you're an options player, there's something unique happening with the ETFs, in particular like the USO or as close to the pure plays as you can get. The implied volatility now finds itself to the advantage of the option buyer. That hasn't happened in a while. So typically, if you wanted to hedge or do something there, it costs you more to apply that hedge. That is not the case right now. There's an advantage there to being a hedger, I don't know, someone who might say, I'd like to buy a call or buy a put. Well, that was typically costing you more. Now it's costing you well below the average there. So it's kind of becoming more interesting to people who say, I'm directional. I believe that oil will bounce. However, I want to risk a fixed amount. I don't want to get stuck in something that just falls apart and I'm wrong. And so the opportunity to do that using options is just cheaper. I don't know. Side topic there. Sorry to bring it up. Okay, let's talk about Cisco here. Stocks in the news. Cisco beat, but they beat on earnings, but lowered their guidance. What do we know from this earnings season? Guidance is everything. We talked about each earnings season having a theme. It's kind of like in politics. You notice how every so often we're like, oh, that's racist, or oh, we don't like the fact that somebody tweeted something, and then the politicians do their thing. Oh, union workers, we should either for or against them, and then like we all just sort of weave around, right? Well, each earnings season is the same thing, only a little less heated and a little less covered on TV, of course. So each earnings season, there's a focus. And it's, oh, you beat earnings by 2 pennies. Okay, that's kind of a given. We're going to be looking at that each earnings season. And so we look at these different things, and you can kind of tell what the theme is going to be. This season, I told you guys it would be forward guidance, and we could see it. If you are a stock who beats on earnings, these guys beat on earnings estimates, revenues were as expected, and all the normal headline topics were fine. Guidance, lower there. Caused the second largest gap since the 1990s in Cisco. That is a theme that has been continuing there. And here's another example. Actually, I didn't even mention Walmart. Walmart moves back down to the bottom end of the uptrend. Some of you will see that as opportunity. Others will say, no way, I'm out of here. They beat on earnings, actually mostly good there. Online sales up 24%. Average ticket growth was only 1.5. That was a bit of you know how I look at that stuff. Average ticket growth only up 1.5%. Their sort of run average or run rate or whatever is about 2.1. So it was a little bit off of what they expected there. Now, they're the biggest retailer. That's why we spend time on this. This is why we follow them. If we can see actual numbers from the consumer, and Walmart being someone who probably touches a lot of our wallets here, right? They're the biggest. What does that do? It totally negates all the stuff that you may hear tomorrow, the next day, and so on. And we go through presidential election season, and people have these thoughts. The politicians will be like, the consumer's stronger than ever, and it's all thanks to me, or whatever they say. We now can look at the largest retailer and go, oh, it's kind of true, but no, you're fibbing a little bit, right? You're not necessarily telling the truth there. The big deal here was, and I kept a lot of these quotes because I want to share with you, the CFO was what ruined, I mean, whether he did it on purpose or not, I don't know, but he ruined the whole thing by saying, essentially lowering their guidance. He said, we are very cautious on the consumer, more cautious than we have been in the last 90 days. And this is because we see a sharper fall off in sales in the last 2 weeks of October. That's not included in this earnings report, right? We're in the fourth quarter now. They're already reporting numbers from back here. So he's giving us a glimpse into their almost up to the second sales. We see a fall off there. We see that there is still an increasing pressure on the consumer. And then he blames like student loan payments, higher interest rates. And so his thought here is might have to have more promotions during the holidays, right? The consumer is struggling a little bit at our store. We could understand Target or something, right? But they're struggling, and we can see that, which means we're going to have to incentivize them with some sales. If we have to incentivize them with sales, it means we won't make as much of a profit as we thought we would make, and therefore that's the Economics 101 breakdown of Walmart. The key there is they are so large that if you start seeing politicians say something about the consumer that's different than actual data, now you know, maybe that's not your guy or gal. Now they all massage the truth, I guess, but now you know, is that person in tune with what is going on, or are they just giving me a talking point? Now, it's going to become more important as we get into the elections. Of course, everybody's going to get all fired up again. Here we go. Macys. A little bit different story here. And the real excitement for them was they were expected to break even, meaning $0 per share. So as a shareholder, their earnings would have been nothing per share, and you would still own the stock for nothing. Well, it turns out they made 21 cents per share, which doesn't sound like a lot, but that's astronomical compared to what the best of the best perceived their earnings to be. So pretty good there. Sales were not down as much. Their inventory down 5%. That's good news. If your inventory is declining, you provide less incentives, less sales, promotions, things like that. So Macys, all in all, was pretty good there. And if you look at their CFO and CEO comments going forward, that's the equivalent of them raising guidance, right? So pretty cool there. And lastly, got Carvana. Everything was okay until Amazon came out and said, yeah, we're going to just sell cars online now, right? So if you are like me and don't want to spend 10 hours at a dealership working on a price of a car, you should just have the price of the car. Carvana is kind of the place you look at, or CarMax does it, AutoNation does it. I think they partially do it. Anyways, Carvana, CarMax, all of them got hit today because Amazon said, we're going to let car manufacturers and dealers sell on our site. They can't actually let the manufacturers, so I'm saying dealers and retracting my previous statement there. They're going to start with Hyundai. And that's because Hyundai worked out a deal with them to put Alexa in the cars and blah, blah, blah. So it was a little give and take there. You know what I mean? What's the incentive? So the concept is you will now go on Amazon, shop for your car, look around. You'll get you'll cash out, do your financing, put it all through, just like you do on Carvana or anything like that. And then they'll either deliver the car to you or you'll come pick it up if you want to pick it up. So that kind of foray into the new car sales market obviously is going to hurt some of those other stocks that did already do that. Anyways, tomorrow you've got 1, 2, 3, 4, 5 Fed presidents, or Fed members, I should say, speaking. And then the only notable earnings, I believe, is BJ Wholesales. They were down thanks to Walmart today, but they'll report tomorrow, so a chance to show maybe a little bit better. And that'll be the only real focus tomorrow for earnings and news announcements there. I'll take your questions if you have any questions. If not, I will move on. Get ready for our class tonight. Some the general things you should always be thinking about for tax saving strategies as the year comes to an end, and then the advanced stuff that you can do that not only people don't talk about, but also how does it work? How do we do it? All right, it's a great idea. I want to do that. What do I do? And then some of the basic stuff I'm actually going to go over and show you some of the things that people get wrong. So we're going to say, well, this is how you do it, right? Instead of what you see on social medias and whatnot there. So anyways, yeah, got a little echo on the audio there. Man, I don't know. I was yelling. Oh, I'm sorry. Do I sound like Dave Ramsey yelling at people? We're picking on him a little bit lately. He was very rude. Sheesh. The divergence between Walmart and Target is always a geeky chart. Yeah, and that's actually like slide 100 and something on my slides here. I just saw that the other night. Occasionally, so I save every slide that we do, and occasionally I'll go to the bottom and work my way up and see like, what were we talking about? Did it come true? Was it something of value? Can we come back and touch on it? And I did see that one last night there, yeah. And it's actually a strategy. I don't remember the guy's name. It was a guy, I just don't remember his name, but he had a strategy of taking like stocks, like the Home Depot and Lowe's, and he had a day-to-day process for how he would actually go about playing both sides and just trying to capture the spread. I don't know if he still does it. I can't remember his name. Yeah. Hey, Dustin. Hey, you got to help out Dustin there, right? That's right. What are your thoughts on using sites like FinViz to get together? Yeah, sure. I don't know like the paid version. There is a paid version still, right? Where'd they go? There is a paid version. I don't know what that now includes. We used to have it years ago, but yeah, absolutely. Go for it. You love the savings percentage example. Keep them up. Okay. Well, if you like that, you'll love our withdrawal example from tomorrow. Tomorrow, me and Eric will have the discussion on the Dave Ramsey thing, and then I'm actually, you know me, I'm not just going to say something. I want to back it up with data, so I'll actually show that data with actual stock market data, and we'll just go through and randomly just go, okay, let's just say we did it from here to here. What would happen? And Doc, that'll be tomorrow, right? Tomorrow. That'll be tomorrow. And just to like pick at him a little bit, did we do the thumbnail thing? So you'll see it. Just to pick on him, we made our thumbnail look like his thumbnails, you know? So if we get a letter from his lawyer, we'll post that too. Williams-Sonoma earnings, did we cover that? Didn't cover it today. So they, it's kind of like Burberry reported overnight as well. They're not based in the U.S. And it was the same concept. If you got the money, you spending it, right? These stinking people with their stuff. Yeah, I'm a little salty when it comes to Williams-Sonoma, though. Or Williams-Sonoma. Oil has dropped quite a bit recently since it crossed. Is it expected to be positive year-end? Oh, positive a year after it crossed. Oh, you want to do a study on that one? How? So we don't have the futures data. So you notice I don't do a lot on oil because remember when oil went negative? We were actually live when that happened, and me and Cody were doing a video. Well, ever since then, they have adjusted, and they may have adjusted back, but the USO, they chickened out, and they said, we know our prospectus says this, but because oil went negative, we are scared, and we are going to adjust, and they just ruined that ETF, in my opinion. It appears they've gone back to business as usual, but I did not like that very much. So anytime we do a study, we're using USO for the most part. We're not getting accurate data because we got discretionary decisions in something that was not supposed to be that way. Somehow they got over that. But I will look and see, maybe there's some other peer play that we can use to kind of see what happens when oil does break there. Yeah. How much further can oil stocks fall? I don't know. If you like a 20% discount at least, then you got that there. Yeah, it's hard to do that. That's like if I said, I promise you, I will give me your money, and I promise you, I will invest only in the S&P, right? And then the S&P starts to fall, and I go, oh my God, and I just buy Tesla. How mad would you be? Like, that's the equivalent of what happened. Just totally getting rid of what they did, changing their futures contracts and going, we're going to do this. I don't like it. I don't like it one bit. Okay. I'm going to get ready for Wine and Wealth. We will see those of you that want to come hang out and clients of Jazz Wealth. We will see you at 8 p.m. tonight. We're going to cover a lot of good stuff there. I'll wish the rest of you a good rest of your day and a happy Friday tomorrow. We will see you when we see you. Thanks for watching.